Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, 9 a.m. Eastern, every Monday morning. Get you ready for the stock market week. Stocks I'm watching, economic news that could highlight the week, and what to watch. Great topic for you this week. With most of the companies in the S&P 500 already reporting earnings, about 69% of the companies reporting earnings so far, we're seeing earnings, profits of S&P 500 companies down 5% from the same quarter over the last year. What's more is analysts expect that to continue 2 more quarters, the first half of this year, to see consecutive quarters of earnings decline. So we're going to see 3 quarters where earnings reported by companies are lower than the previous year. We are already in an earnings recession, folks, and it's just a matter of time before the rest of the economy could follow it into a recession. But looking at the jobs report, the surprisingly strong jobs report over the last month, 517,000 jobs added in the United States. That's almost 3 times more than what was expected. Very strong labor market. Looking over that, it occurred to me that it might be a clue into what are the safety stocks going to be over this recession, and if stocks do fall further. I'm not talking about utilities or consumer staples. Those, while they have held up over the last year against the stock market crash, they've still lost as well. I'm thinking some other stocks here in the jobs report could be safety stocks over this next year. I want to share that with you. I want to get to our stocks to watch this week and the economic news to highlight. Before that, I do want to highlight a special offer from Seeking Alpha. Click through the link I'll leave in the description below. You're going to get 50% off. Save $120 off the annual subscription for premium access. I use it for the research, for the earnings report. Click through, you're going to see all kinds of great features like the stock screener, those earnings reports that are so important for during this time of earnings season. Click through, you're going to save $120 off for the annual subscription, and it helps support the channel, so I appreciate that. But back to those safety stocks, because despite the jump off the October lows, there's still reason to believe that the stock market could sell off over the next 5 or 6 months. It's already sold off last week. It's looking like it's going to start the week on a low. The Fed has increased interest rates at the fastest pace of over 40 years, increased that cost of borrowing for businesses, for households. We've already seen the housing market is in shambles and falling. We're expecting those 3 consecutive quarters of falling corporate profits, and right now companies in the S&P 500 are only expected to post earnings growth of 3% a year. So we are in the midst of an earnings recession. The economy will probably follow it into a recession over the next 6 to 12 months. And that's going to be a burden on stocks. And daily we hear of more of those big tech layoffs. A recent survey by layoffs.fyi tallied 150,000 layoffs alone across just the 1,000 tech firms it follows. You know, Amazon's cutting 18,000 jobs. Alphabet is cutting 12,000, and a lot of these tech companies cutting by 10 to 20% or more. But against that, we also know that the jobs market is still extremely, surprisingly strong. The U.S. added over 1.1 million jobs in just the 3 months through January, and 500,000 in January alone. Again, that was more than 3 times the number of jobs we expected. So there is obviously some kind of a disconnect between the labor market and the economy. And again, something that might help us find those safe stocks in the coming recession. And again, I'm not talking about those traditional safety stocks in the utilities or consumer staples sector. Here we see the sector performance over the last year, with the stock market down 10% just over the last year. Utilities are up 1%, but then that consumer staples sector down 3.3%. So while it has fallen less than the rest of the market, they haven't really protected your money as well as they should. And to do that, we're going to dig deep into the jobs report, into the specific industries that are hiring workers, to see which might be the industries that are still growing, the industries, the sectors that are still adding workers, looking for growth, and might be safe in the coming recession. Here we are in the Bureau of Labor Statistics, the graphics for economic news releases. If you type in Google jobs report by sector, you're going to find this. It's going to be the employment by industry monthly changes. We're here on the 1-month chart just to look at those January numbers, see where that strength was, because again, those January jobs were 3 times more than what we expected. So we're going to scroll down here. You can see the industries here as far as how many jobs, how many thousands of jobs they added there in January. And we're going to look at this. We're going to dive deeper into these to see exactly where those jobs were. You can see that some of these obviously information technology lost 5,000 jobs net. Mining and logging was very weak. Utilities lost jobs. Financial activities saw a very, very weak 6,000 jobs added. But then you see where the strength is in the economy. Employers in healthcare, education, leisure, and hospitality account for just 36% of this private sector jobs. Okay, so you've got here leisure and hospitality, private education and health services. That is just a third of the private sector jobs. but have accounted for 63% of the job gains over the last 6 months. So that is two-thirds of the job gains in the last 6 months have been all on the shoulders of just a third of the economy. And just the last half year, the groups added these two industries have added over 1.2 million jobs alone. So clearly, these two industries here, private education and health services and leisure and hospitality, is extremely strong. And we know that because of these jobs reports. Now, if we click on any of these, we can see the detail within it. We'll click on leisure and hospitality, and we can see here where the real strength is in this. It's not the arts, entertainment, or recreation. It is in this accommodation and food services. In that January data, restaurants added 99,000 employees. That is 1 in 5 of the jobs created in the entire United States. They're in the restaurant industry. So very strong restaurants, very strong part of the economy. We can click back and then click into this private education and health workers. We see that private education added 25,000 jobs, social assistance added 21,000 jobs, but the real strength here we see is obviously in healthcare, adding 58,000 jobs in the last month alone. And so we can immediately see where the growth is still at in the economy, where that demand is. It is in accommodation and food services, so think hotels, motels, restaurants, fast food. It is in healthcare services, so think hospitals, facilities, things like that. And what's more is with these other industries and the general economy slowing, these stronger industries are going to have an progressively easier time finding those workers without having to raise their wages or offer those bonuses. A big part of the weakness in healthcare stocks lately over the last year has really been the fear that worker shortage is really going to demand higher wages, bigger bonuses. It's going to eat into the profits of those healthcare facilities, those healthcare companies. As people get pulled in from other industries that are laying off workers, you're going to see a lot easier hiring and that continued demand for these stocks. So now using all this, you can find those stocks that might be safe in the coming recession, because as the rest of the economy slows, as a lot of these other industries like tech weakens and starts laying off workers, you're still going to have that demand in these industries like healthcare, in accommodation, in food services. So what you want to do, you want to find the best of breed stocks in those. You can use any stock screener you want. I'm just using the stock screener here on Yahoo because it's free and available to anyone. You just go to screeners, you click on there, you're going to find equity screener. If you go here, you go to something like United States, you want to go to mega cap and large cap, because really what we're looking for here is those super giant companies with plenty of financial flexibility to withstand, to survive any kind of a recession. So you do want to preference this to larger and mega cap companies. Then you're going to pick your sectors. Here we're looking at healthcare. We're looking at consumer cyclical, which is that restaurant. It's the accommodation, the hotels, and normally consumer cyclical would fall in a recession. It would get hit as consumer spending comes down. But I think that the services, the demand for those services is still going to be high. They're still going to be hiring, and I think you're going to find surprisingly strong stocks in that industry within consumer cyclical. So what we'll do, we'll click on healthcare here. Then you're going to go down to industry, and you want to pick the ones that you think are participating in this hiring boom, in this demand growth. And really what I'm looking for here is the medical care facilities. They're the ones struggling under that worker shortage, under the nursing shortage. They're finding it easier now to pull people from other industries that are laying off workers. That's where the demand really is for those medical care facilities. So we're going to click on that, and we're going to find stocks. And here you're going to see all the stocks for that. I like HCA Healthcare, one of the largest healthcare providers, hospital providers here in the country. They are going to be benefiting from this trend. You can do the same thing in that consumer cyclical sector, looking through some of the accommodation and food services. Some of the other companies I'm watching, Medical Properties Trust. It's a healthcare REIT, so it owns the healthcare properties, the hospitals, the doctor's offices, things like that, and leases them back. That demand and that strong growth in the healthcare sector is going to lift a big weight off Medical Properties Trust. The stock was down big last year on the worries that the demand might push wages up higher for these medical service providers, push a lot of them out of business. But I think that's going to lift this year. You can also look at some of those restaurants. Restaurant Brands International is declaring its earnings this week. We're going to talk about that. Darden Restaurants is another restaurant provider. You've got MGM Resorts as well as Marriott. Now I want to highlight some of the stocks I'm watching this week. Big earnings week again this week. We've got Marriott International, ticker MAR, as well as Restaurant Brands, that's ticker QSR. both reporting earnings on Tuesday. It's both in that theme of the strong hiring demand. I think the demand for services is going to continue for both of these, for all of these, those Darden restaurants, the restaurant brands, QSR, which is Tim Horton there in Canada, and Burger King, a lot of the fast food joints. So again, that hiring and food services, travel-related companies has just continued to surprise higher with consumers still spending for those services. So I'm going to watch closely what the companies say about inflation. The big thing here is if they are able to keep their operating margins fairly stable from the last year. Okay, again, the big fear in healthcare services, in restaurants, in accommodation and food services is that hiring demand is so strong that they're having to raise their wages, and that's going to eat into their profitability. Okay, they're already having to cover some of the other inflationary costs in the economy. If their wages go up too far too fast, it's going to really hurt their profitability. So that's what I'm watching for. I'm watching for the companies that are able to keep those operating margins, that operating profitability stable. Those are the companies where you're going to see with that strong demand for their services, any of them that can control that inflation and keep that profitability, they're going to see their earnings climb, and that will outperform the market. I'm also watching Devon Energy here, ticker DVN. It's also reporting its earnings on Tuesday, expected to post another jump in earnings to $1.76 a share. That would be an increase of just 4% in revenue. Management already cut the dividend last quarter to protect that cash flow, seeing that from a lot of energy companies talking about lower cash flows this year, just as oil prices have come down. If you remember, back in February of last year, Russia invaded Ukraine, sent oil price up to $100, eventually up to $120 a barrel. That lasted through the first 6 months of last year. So what I'm looking at here in the first 6 months of this year, energy companies are going to see still very high cash flow, but it's going to be lower compared to last year. So they're going to start talking about slowing the dividend growth, maybe buying back less shares over the next 6 months, and that could worry investors. And so again, management cut the dividend last quarter. I think that keeps the dividend here, the 8.5% dividend yield, very safe here. So I think you've got a tough comparison here for the first and second quarter with this. That's going to keep the stock a little worried, a little muted, but the dividend is safe, and I think you're getting a great company with Devon. Generac Holdings, ticker GNRC. This was the worst performing stock in the S&P 500 last year. It lost 57% of its value. Company reports its earnings on Wednesday, with the market expecting a sharp drop, a 30% drop in profits to $1.76 a share. That would be on flat revenue of about $1 billion. This is the leader in portable generators. Okay, upwards of 80% of the portable generators market, just a commanding lead, a very strong cash flow positive company, but it is attempting to expand into solar power. Okay, so the sell-off in alt energy last year, alternative energy, especially solar last year, really brought this stock down to its knees. Again, lost 57% of its value. It's really just a threat that the company is sacrificing those historically stable cash flows from the generator market just to invest in the solar market. I think the market's wrong, though. I actually bought shares of this company in January, already up about 15%. I think the company has a strong long-term potential to fund those solar ambitions with the cash flows from its generator segment. And as soon as those solar stocks rebound, and you know they will, they always do, this stock could jump higher. Again, I bought in January for about $102 a share. It's already up about 15% from there, and I think it has a long way to go. DraftKings, ticker DKNG, is going to also report its earnings here on Thursday, with the stock down 73% from its pandemic peak. The earnings loss is expected to narrow to 59 cents a share this quarter, but it's still expected to post negative earnings for the next couple of years. But it's growing sales by 68% a year. So I do believe this one is going to grow out of those problems. DraftKings is the leader in a growing industry. Several large states have yet to approve online gambling. We still have California and Texas to approve online gambling sometime. Florida's getting close, I can tell you, and that is going to open up 3 very big markets. DraftKings, the second in the space, has about a 34% market share against FanDuel, but a very good stock for that long term. I think this is going to help the company continue that pace of revenue growth and eventually lead to those positive earnings. Again, I started to buy into the shares back in October for a long-term accumulation. I can see the stock getting back to $70 a share in 5 years. That would be on about $9 billion in revenue by 2028. It's about a 25% annualized pace and a 3.5 times price to sales ratio. Of course, lots of companies still coming out with their earnings this week, going to be a very important part of the market, but investors are going to be firmly focused on that CPI report, the Consumer Price Index of Inflation. inflation coming out on Tuesday. This rally since October has been completely built on the idea that inflation is coming down, that the Fed is going to be able to slow its interest rate increases and eventually cut rates to support the economy if we do fall into a recession. The drop in the rate of inflation from about 9% mid last year to a 6.5% last month, that has supported this idea, this hope. But that rally is going to need that inflation to keep on weakening, that inflation rate to keep on coming down if it's going to continue to drive stocks higher. And the problem is, folks, I think that big drop in inflation just gets harder and more difficult to continue. Okay, that drop from 9 to 6.5 in consumer inflation has been really easy on that fix and supply chain issues, a softening of food inflation, a lot of the things that we saw during the pandemic that are now coming off, and dropping that part of inflation, dropping further to the 3% that most people think it's going to end the rest of the year. We saw before the pandemic, it's going to be harder considering that a lot of the parts of the economy here, not only rent prices, other parts of consumer prices, they continue to rise and are resistant to coming down. Now, the market is expecting the Tuesday's CPI report, that consumer prices inflation, to show further disinflation to 6.2%, so a pace of 6.2% over the last year versus 6.5% last month, as well as core inflation down to about 5.5%. Now, whether it starts Tuesday or next month's CPI, I think there is going to be a period of a few months here where investors are just ultimately disappointed with that further rate of inflation. Okay, I think it's going to be stickier, it's going to be stronger and more persistent than people believe. As stated, the market is just priced for a Goldilocks scenario. That's going to set us up for a drop in investor sentiment and a period of weaker stock prices. So I really think you do watch for those safety stocks. You maybe even position in some of these other safety stocks, the traditional safety sectors like utilities, like consumer staples, because I do think what it means for the market is going to be a couple of weeks or a couple of months of weaker prices. Use the link I'll leave in the description below to save $120 off premium access on Seeking Alpha, or click on the video to the right for the one bond ETF every investor must own. Protect yourself from the coming recession with this one ETF. Don't forget to join the community by tapping that subscribe button and clicking the bell notification.